Silver just staged a powerful rebound, jumping roughly 22% off yesterday's low, climbing from around $65 to the high 70s. Spot silver traded near 77 per ounce, marking a sharp recovery in a very short window. The move was fast and aggressive, reclaiming the 78 level after the recent drop. At the same time, Bitcoin surged by about $11,000 in 24 hours and pushed back above 70,000. The total crypto market added hundreds of billions in value in a single day. U.S. equities also snapped back hard, with over $1 trillion in market cap added within hours, as the Nasdaq and S&P 500 erased their prior decline. The Dow rallied nearly 1,000 points to fresh record territory. Current spot pricing shows silver around the upper 70s in Western markets and low 80s in Shanghai. Silver printed a correction low near 65 and then rapidly bounced to the high 70s, about a 22% swing in roughly a day. That kind of reversal rarely shows up clearly in mainstream coverage, yet the move has been forceful and broad-based across risk assets. Crypto mirrored the shift. Bitcoin rebounded strongly. Ethereum jumped back above the 2000 zone after trading in the mid-1700s, and hundreds of millions in short positions were liquidated. Billions flowed back into digital assets within hours. Small-cap U.S. stocks also outperformed, with the Russell 2000 rising over 3% and recovering its earlier losses. Smaller, higher beta assets are reacting faster than large caps, the same behavior seen in crypto pairs relative to Bitcoin itself. Over the past few weeks, Bitcoin fell roughly a third from its highs, yet many alternative coin pairs held relative strength. That tells you speculative appetite never fully disappeared. It rotated. The repeating pattern this year has been sharp sell-offs, followed by equally sharp recoveries across stocks, metals, and crypto. At some stage, repeated volatility starts to look more like structured intervention and positioning games. Headlines, narratives, and sentiment swing wildly, but underlying flows eventually show through. A key question now is whether the recent silver low marks a durable bottom. One widely shared market comment put it simply: bull markets are not ended by corrections, they are ended by overcrowded consensus. Supporting that idea is the spike in the one-month silver lease rate in London, which recently jumped above 6%. Elevated lease rates typically signal tight physical supply and strong borrowing demand. If metal were abundant, borrowing costs would not be this high. The message from the lease market is that paper leverage was flushed out while physical demand stayed firm. Spot indicators and forward structure continue to show backwardation, another sign of near-term tightness. Futures positioning adds another layer. Open interest in gold futures dropped to its lowest level since late 2018 after a steep washout from recent highs. That kind of contraction usually means speculative length has been cleared. When traders re-enter, open interest tends to rebuild alongside price. Day-to-day swings can remain erratic, but historically this type of reset often forms a base for higher pricing over the following weeks. Physical flows in China are also notable. Exchange warehouse silver inventories there have fallen dramatically over the past several years, with thousands of tons drawn down since 2020. Combined exchange holdings sit far below prior levels after another large single-day withdrawal. If that pace continued, available stocks would shrink very quickly. Chinese buyers appear to be accumulating into weakness, and as the world's largest precious metals consumer, that matters for global supply dynamics. Geopolitics adds further complexity. Tensions involving Iran and U.S. policy actions have risen again, including new sanctions measures following unsuccessful talks. Whenever geopolitical risk premiums increase, precious metals often receive additional support as defensive assets. From a longer-term perspective, silver's pullback looks very different depending on time frame. When charted against money supply growth over decades, the recent surge broke above its historical band, and the current drop resembles a retest rather than a full trend failure, at least for now. Price still has not exceeded the extreme highs seen in the early 2010s, despite much larger monetary aggregates today. Timing is uncertain, but the broader move may not be finished. Context matters more than daily noise. Major market cycles are rarely smooth. Large structural trends tend to be volatile and psychologically difficult. Understanding the drivers, supply, leverage, positioning, and liquidity makes that volatility easier to navigate. Silver mining equities could become a major focus next. In prior bull cycles, silver prices multiplied, but leading miners rose several times more than the metal itself. Historically, miner ETFs and top producers have delivered roughly triple and sometimes far greater percentage gains compared to spot silver. Recently, however, many mining shares lagged the metal because analysts were still modeling much lower average silver prices. That mismatch may correct as new earnings reports reflect higher realized prices and stronger cash flow. Gold miners previously showed the same pattern: early lag, then explosive catch-up once margins expanded and estimates were revised upward. Balance sheet limits at large banks also matter here. Financial institutions cannot expand paper exposure without constraint forever. When physical demand begins to dominate paper supply, repricing pressure builds. Looking ahead, the COMEX March delivery cycle is a potential pressure point. Open interest heading into March sits near 429 million ounces, while registered inventory is just over 103 million ounces. If delivery activity continues at recent intensity levels, 50 to 70% of contracts standing for delivery, demand could reach 200 to 300 million ounces, far exceeding the available supply. February deliveries have already cleared nearly all open contracts, and the current pace of warehouse withdrawals suggests physical tightness will intensify as we approach the first notice day in late February. The math implies that a supply crunch could become unavoidable if the current structure persists. Bitcoin adds another layer of uncertainty. Historical bear markets show that drawdowns often exceed 70% from all-time highs, even when each successive cycle has been shallower. Applying that pattern to the current Bitcoin price implies a potential test near 38,000. Cryptocurrency behavior continues to influence broader risk appetite, and silver and gold remain correlated to these flows. A pause or base building in Bitcoin is therefore critical for metal stability. The takeaway? While silver and Bitcoin have rallied sharply in the short term, volatility remains a strong possibility, and full confirmation of a bottom requires time. Technical indicators also illustrate the swings in sentiment. In mid-December, silver was at 65 with extreme bullishness on the RSI. Today, the price is at the same level, but sentiment is heavily bearish and RSI is near 30. Same level, completely opposite psychology. That doesn't guarantee a bottom. Markets can stay oversold for longer than expected, especially amid deleveraging and liquidation events. Large, violent declines are often followed by equally rapid rebounds, but often does not equal certainty. Looking at structural signals, gold's long-term parabolic trend remains intact, suggesting the broader precious metals bull market is still valid. Silver must hold current levels and consolidate before confirming a bottom, but exhaustion of selling pressure is already visible. COMEX gold open interest is at its lowest since late 2018. Silver lease rates remain elevated at 6.1%, backwardation persists, and Chinese vaults continue to drain large quantities. These are clear signs of physical tightness rather than abundance, highlighting ongoing structural constraints. Summarizing the key takeaways. 1. Silver rebounded 22% from 65 to 78. Bitcoin reclaimed 70,000, adding tens of billions in crypto value. U.S. equities recovered over $1 trillion in hours. Risk-on sentiment returned aggressively across multiple asset classes. Short squeezes and dip buying drove rapid moves. 2. Elevated silver lease rates, persistent backwardation, minimal COMEX open interest, and accelerating withdrawals from Chinese vaults confirm that physical supply is tight. Long-term charts show this is more a retest than a trend reversal, and perspective matters more than short-term noise. 3. March delivery math is critical. Open interest versus registered supply, combined with historical delivery rates, points to potential stress in COMEX silver. Miners reporting earnings this month could also trigger a strong catch-up in equities, consistent with historical leverage patterns. Banks cannot infinitely manipulate metals markets. Structural limits will matter as physical demand overwhelms paper supply. The central question remains unresolved. Did we see a durable low at 65 with this 22% bounce, or is this just a temporary relief rally before further downward pressure? The coming 3 weeks are pivotal. COMEX delivery mechanics, crypto volatility, and physical market tightness will reveal whether repricing or further deleveraging dominates. Right now, supply constraints are severe, but technical confirmation is still developing. Investors should act based on careful analysis, not emotion or hype, and always align trades with timeframe awareness. Volatility will continue, but understanding the dynamics, physical tightness, leverage flushes, short covering, and macro flows allows for rational positioning. The next few weeks will likely determine if March delivery pressures force silver repricing or if markets remain in controlled adjustment. Physical flows, structural scarcity, and minor performance suggest significant upside potential exists once these mechanics play out. Silver is tight, miners are poised for gains, crypto remains volatile, and the market is in a structurally fragile but opportunity-rich state. Risk-on returns can be sharp and sudden, but logic, data, and perspective remain the best tools to navigate it. Invest with analysis, not emotion. If you found this analysis helpful, hit the like button, share this video with anyone following silver or crypto, and subscribe to the channel for more in-depth market updates. Don't forget to turn on notifications so you never miss a key update.